After weeks of trouble and a $30 billion lifeline in mid-March from America's biggest banks, U.S. regulators took over First Republic.
I think it was inevitable. You could see it coming.
The San Francisco-based bank becomes the third to fail in the U.S. in 2 months. First Republic's assets are being sold to J.P. Morgan Chase, America's biggest bank. Customers saw 84 branches across 8 states reopen Monday under the new name after regulators worked all weekend to get the deal done. This is now the second largest bank failure in U.S. history.
All of these sort of helter-skelter moves, like these midnight deals and marathon sessions over the weekend, are trying to firewall the banking system and prevent it from becoming systemic.
On Friday, a report examining the collapse of California-based Silicon Valley Bank blamed its demise on poor management and watered-down regulation, saying the industry needs stricter policing to prevent future failures.
The banking industry during the Trump years lobbied the Trump administration to water down the regulations imposed after 2008-9, and I think that was a mistake.
First Republic's demise isn't expected to stop the American Central Bank from going ahead with a rate hike on Wednesday.
I think we are, in my opinion, past the worst case scenario, but we'll have to see over the next 3 to 6 months, especially if the Fed continues to raise interest rates. Could things percolate to the surface again?
Economists say weaker U.S. growth will weigh on Canada's economy, specifically exports. The good news is that deposit outflows that we saw at First Republic, where $100 billion worth of deposits were pulled out in the first quarter of this year, aren't happening at other U.S. banks. But it doesn't mean we're out of the woods just yet. Anne Gaviola, Global News, Toronto.